Good afternoon, everyone, and welcome to our Cost Segregation Software and Tax Strategies webinar. My name is Chris. I'll be helping out with the introduction and polling questions today. Today's speaker will be the manager of our Dallas-Fort Worth office, Ryan Vandervelden. For best audio, please dial in using the phone number provided. If you experience audio issues, please log out and log back in. You can download the slides for this presentation at kbkg.com/resources. Please answer all polling questions throughout the presentation in order to receive CPE credit. If you have any questions, please submit them in the question box. We will do our best to answer all your questions during the presentation. We'd like to begin our webinar with a little background about our company. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, New York, Georgia, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG has performed studies in facilities ranging from the size of tens of thousands to over 1 million square feet, resulting in deferrals of hundreds of millions of dollars in taxes. We also have high qualified engineers and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimated techniques. Our tax department provides support for all cost segregation tax related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are the preferred provider for thousands of CPAs across the country. I will now introduce our speaker, Ryan Vandervelden. Ryan is a manager with KBKG and is based out of KBKG Texas office in Dallas-Fort Worth Metroplex. Ryan graduated with a degree in civil engineering from California State University, Chico, and is a certified member of the ASCP SP. I will now turn over the floor over to Ryan.
All right, thanks, Chris. Can you hear me okay?
Yes.
All right, so welcome everyone. Thank you for joining us today. Got a lot of good material for everyone. So before we dive in, let's review some of the learning objectives. First, we're going to go through an overview of cost segregation. We're going to look at some of the benefits, and we're going to go into some of the tax considerations. And then next, we'll go into we'll take a little deeper dive into some of the tax considerations and strategies. And then for the second half of the webinar, we're actually going to do a live demonstration of the residential cost segregator tool. So cost segregation, it's been around for a long time. It's been around in one form or another, but there's two basic goals with a cost segregation study. So the first goal is we want to identify property-related costs that can be depreciated over accelerated recovery periods. So 5-year property, 7-year property, and 15-year property. We want to do that, so we take these tax deductions earlier in the ownership of the property, and this increases cash flow. And this just creates a time value of money for having cash now versus cash later. And then there's a secondary goal here that really kind of gets overlooked sometimes, but it's still very important. And the secondary goal is through the cost segregation study, in identifying all the shorter recovery periods for the different costs that qualify for those, you also are identifying costs for other major building components. They maybe not be depreciated faster, but you're still identifying a basis in them. And what that's helpful for is if those components are going to be replaced. So for example, let's say you replace the roof in 5 years. Maybe you upgrade some windows, doors, things like that, HVAC. These are typical fixes that you have over the life of a property. And so what the cost segregation study does is it identifies the basis in those components. And then when you go to write off those components as they're being removed from service, you can claim a retirement loss or a partial disposition deduction for the remaining depreciation that's left on the retired component. And so there's 4 basic types of property that we look at in a cost segregation study. Really, there's there's two, but new construction is one that has a couple different components to it. So the first one is acquired property, though. So this is property that was acquired by a taxpayer that's already existing. So this building was operating, is in service from another taxpayer, and so a new taxpayer comes in, buys that property, and now they are the taxpayers who are depreciating the components of that. And so in this situation, because it's an acquired property, you're basically taking the depreciable portion of the purchase price that's been allocated. You have allocations to land and you have allocations to building. And so the cost segregation study is primarily focused on the depreciable portion, so the portion allocated to the improvements, basically. And then the next one, new construction. So this is ground up, brand new construction, and this was placed in service for the first time by the taxpayer. And so in this case, you would basically take the total capitalized cost of construction, and this is what you would use for the beginning of the cost segregation study to identify the different cost basis in the different recovery periods. And then the next two, remodeled property interior improvements, these are basically just similar to new construction, but instead of being ground up construction, maybe you remodeled an interior space within an existing building that you own. Or for interior improvements, maybe you bought a shell space within a shopping center or something like that. And so you basically paid to renovate the interior of that space for your business. And so those are four primary examples that we look at. So let's go into an example here. We have a $3 million retail building. So without doing a cost segregation study, you would basically take the costs and you would depreciate them straight line over 39 years. Now with a cost segregation study, let's say for the example here, we identified $330,000 of 5-year property and $360,000 of 15-year property. Now, just by making those reclassifications, we've increased our deductions over the first 5 years to $610,000. And we've increased the cash flow over the first 5 years to $237,000. And for the example here, this is a property that's in California. It's placed in service in June of 2021, and 100% bonus applies for federal purposes. And we'll go into bonus a little bit more later on in the webinar. So let's look at this as a tax planning tool. This is one of the most common tax planning tools for anyone that's associated with real estate. You can do the study at any time. You can do this after the building has been purchased. You can go back and do what we call a look back study, and there's different ways to claim deductions based on when you decide to take advantage of the cost segregation study. And so you would do this because, let's say you have the probability of a taxable event in future years. You may not want to take the deductions right now because you don't necessarily need them. So maybe you want to delay doing the study for a couple of years until you get to that taxable event, and then you want to use the deductions there. And the way that we do this, you don't have to amend any tax returns to take advantage of deductions in a future year. Essentially what you would do is you would file IRS Form 3115, and you would use that form to claim any missed deductions in the year in which you decide to apply the study. Now there is a time period that we would look at that's kind of like a sweet spot for taking advantage of this. If you get too far away from the original place in service date, you've already banked a lot of deductions just through your normal depreciation of straight line over 39 years. And so you have to consider that as you're planning as well. Now, the software that we're going to talk about today, this is really for cost segregation studies that might have lower tax bases. And so typically you would hire a CSP engineer for a tax basis over $750,000. And you can see the estimate cost here is about between $5,000 and $10,000. So the software that we're going to go over today is really for properties that are tax basis of less than $750,000. Okay, we mentioned some tax considerations. Let's go over a few of those here. So the depreciation deductions that will reduce the alternative minimum tax, or AMT, Bonus depreciation is applied to reclassified items in the cost segregation study for both acquired property and for newly constructed property. Any unused deductions will carry forward to future tax years. When the building is sold, the taxpayer and/or the seller may need to recapture depreciation that was taken on the tangible personal property. We mentioned it on the previous slide, but accounting method changes are addressed with IRS Form 3115. This means you can retroactively address buildings from prior tax years. We've got passive activity rules that we need to pay attention to. And the passive activity rules, you can offset the benefits of doing a cost segregation study. So if you have real estate activity as passive, then you must use the deduction against income that is also passive. And in the consideration of a 1031 exchange, we would typically, for a cost segregation study, be looking at the net increase in depreciable basis that is associated with the replacement property in a 1031 exchange. Okay, bonus depreciation. This is one question that's been coming up a lot more lately since we are in 2022 and we are starting to see the phase down. We'll start to see that next year. But currently, for property that was placed in service between September 27th, 2017, which is when the Tax Cuts and Jobs Act first went into effect, through 2022, the bonus depreciation rate is 100%. And this is just for applicable assets. And so you might have heard me mention on the last slide that we can look at bonus depreciation. It's considered for acquired property and newly constructed property. Now, in previous years before the Tax Cuts and Jobs Act was implemented, you could only take bonus depreciation on what they called original use property. So that means the property had to be constructed and placed in service for the first time by the taxpayer. And that still holds for the current Tax Cuts and Jobs Act rules, but they also expanded it to apply to applicable property for acquired property, which has not been done before. Bonus has been around since 2001, and this is the first time that we've been able to take bonus depreciation on accelerated recovery periods for acquired property. And taxpayers still have the option; they can elect out of bonus completely. The way you would make the election is you would elect out of the tax year, or for the tax year in question, and you would elect out of the recovery period. So all 5-year property or all 15-year property in the year you make the change or the election would not get bonus. Taxpayers that are considered a real property trade or business, if they elect out of the limitation on interest deductions, then they are forced to use the alternative depreciation system, or ADS. And that limitation, this is only applicable to businesses with less than $25 million in revenue. That's average revenue over the last 3 years. And what this means is that they have to use the ADS life for commercial buildings and residential rental properties. And so you have a 40-year recovery period using ADS on non-residential real property and 30-year recovery period on residential rental property. And bonus depreciation is not available when ADS is mandatory. And if you have any questions about the real property trade or business, you can look at the definition in the code section listed on the slide. Okay, so let's go into that just a little bit more. So this ADS requirement, you might be thinking bonus depreciation is not allowed on ADS. Well, what does this mean for a cost segregation study? So if you're electing out of the interest limitations, you must use ADS recovery periods on the real property. So this is non-residential real property or residential rental property. This is the long life property, 39-year typical recovery period using GDS, or 27.5-year for residential rental property using GDS. Now, this mandatory ADS is not applicable for tangible personal property. And so even if you make this election, you could still take bonus on the tangible personal property. It still retains its GDS recovery period, so you would still apply 5-year or 7-year, depending on what asset class you're working under. And you can apply bonus to that if it meets the other standards for bonus depreciation. Now, land improvements, these are an interesting one because these are Section 1250 property. But when they made the definition for the ADS, the mandatory ADS for this election out of interest limitations, land improvements weren't on the definition list. And so Because of this, land improvements stay 15-year property, and they also retain their eligibility for bonus depreciation if they meet the other requirements as well. And so that's a huge thing for cost segregation. So if you make that limitation, you're not necessarily, you could still do cost segregation if it still makes sense. Okay, so there's some written binding contract rules that also came into effect with the Tax Cuts and Jobs Act. I won't go into too much of this in a lot of detail, but essentially this written binding contract rule needs to be considered if we're looking at properties that were placed in service in a prior tax year. So if we're analyzing something from 2017, we just need to make sure that if they meet the requirements for application of bonus depreciation, that they meet this written binding contract rule. And so for an example here, let's say a client acquired the building on October 1st, but they went under contract on September 1st. Now, September 1st is still not where that September 28th threshold. That's when the Tax Cuts and Jobs Act went into effect. And so based on that, it's likely that they would have to apply the PATH Act rules for bonus. And under the PATH Act rules for bonus, it is not allowed on acquired property. And so these are just things you need to consider. So as you're looking at that kind of stuff, we always advise our clients to consult with attorney, tax advisor, and just to make sure they fully understand the binding nature of the contract. Okay, so Section 754 elections. This is a type of step up, and this also receives the new bonus depreciation rate. It does this as long as the new partner coming in has not used the property before. And we'll go into a little bit more of step-ups upon death, but this is specifically excluded from bonus depreciation if the property was received from a decedent. Let's go into a little bit more of some of these tax considerations, and let's look at estate planning. So cost segregation is a very useful tool in estate planning. Let's start with some basic rules here, and this is for real estate property. And so property that is inherited from a decedent that has appreciated in value, any gains built up during the decedent's life are forgiven. The beneficiary, when they receive the property, they get a step up to fair market value as of the date of the death, and depreciation starts all over. Now, because of the step up, there's a time-sensitive opportunity here to apply cost segregation to the decedent's pre-stepped up basis. And if we apply the cost segregation study to that, we create a permanent tax deduction. So let's look at this from as an example here. So we've got the current step-up rules. We've got an apartment building that was purchased for $1 million in March 2014, and this was purchased by the decedent, and the date of the death occurred August of 2021. Since the original investment of $1 million is considered residential rental property, we will consider this 27.5-year property for the long life property. So let's say by the time of the death, the decedent will still have approximately $728,000 of depreciation that they never were able to deduct. And the decedent's estate still needs to file a final tax return. It needs to be prepared for the period of 2021 when they were still alive. Now, suppose the decedent had sold the property for $2 million before they died. This would have created a taxable gain of $1.27 million. But in our situation, that doesn't happen because this is inherited property, and the current estate tax rules forgive any taxable gains built up by the decedent. So the beneficiary receives a full step up to full fair market value as of the date of the death. And let's say for this example that fair market value is $2 million. They will record that $2 million basis, and they will continue to start depreciating that moving forward. Now, if you were to look at a $2 million residential rental property, most tax preparers would know that this is a great candidate for cost segregation. But it's the original pre-step value that has the most value here. And so because of the time-sensitive opportunity, you have to file this final tax return in 2020 for the 2021 tax year. And so what we'll do is we basically will do a cost segregation study on the original pre-stepped up undepreciated basis. Sorry, not undepreciated basis, but the basis in the property from the decedent. And so we have to file our tax return for the months of January through August. We do a cost segregation study, and we file IRS Form 3115. Remember, we do that when a property was placed in service in a prior tax year. And through the 41A adjustment that gets reported on the Form 3115, we've generated approximately $174,000 of catch-up depreciation deductions. And so when we file this on the final tax return, we realize a permanent tax savings of approximately $64,000. Now, if we had not done this, these deductions would have been lost forever. And so applying it to the final tax return takes advantage of cost segregation for the final return. Now, for the heirs' perspective, they stepped up the property to the full fair market value. Well, since they just did a cost segregation study on the same property, looking back from a previous year it was placed in service, they might consider engaging with the same cost segregation firm to basically do like a refresh of the cost seg for the property as it stood in the year of the death, where you would apply the fair market value. Probably some minimal changes here. If it had been placed in service in 10 years past, there probably some different components, things like that, maintenance thing that you would consider when you do a cost segregation study. And so probably for a nominal cost, they would go in and refresh the original cost segregation study, and they could apply that so the heirs can take advantage of the accelerated depreciation deductions on the new basis. Okay, so about 25-minute mark here, we're going to go into the residential cost segregator software, or RCS. This is really designed for tax preparers. What this does is you can generate a report without the need to hire a third-party engineer. And now there's some limitations to the software. It's only for residential rental properties with up to 6 units, and they have a depreciable tax basis of $600,000 or less. Now this is the purchase price less land. This is the depreciable component of that. So it has to be $600,000 or less. And we're going to go through the exercise here, but basically you input the information for your building into the software, and then the software generates the cost segregation study. Go to the next slide here. So very simple. It'll take a little bit of time for us because we're going to go through it kind of slowly so I can show you all the different features. But if you were looking at this, it would probably take less than 15 minutes of time. You could even email your client a questionnaire that gives them the information that you would then go in and input. And then you could white label that report, and you can charge your clients for the work doing of this RCS. Okay, so with that, I'm going to pull my screen over here. Can you see this okay, Chris?
Yes, I can.
Okay, so here is the KBKG Solutions website. Let me change this here. Okay, so here's the dashboard here. We've got a couple different software services. We have the RCS, like I mentioned. We have a 481A calculator subscription. There's a cost seg calculator where you can go in and put some basic information about your property and see if there's some potential to do a cost segregation study. And then we also have a partial disposition calculator. So I'll go into a little bit more about the partial disposition calculator later on in the presentation, but for now, let's dive into the RCS, the residential cost segregator. So we click on this screen here, and basically we come up to a report screen. So let's start a new report. And here's the basic interface of the software. So I've got a couple different tabs here: general, interior, exterior, tax benefits, and review. Everything that's in a red border with yellow fill is a required step. And so what we'll do here is we're just going to go through the typical exercise of entering in some information for the RCS. So let's pick a street address. We can just pick something simple here, 123 Main Street. I think they did that on a Simpsons episode way back when, and it'll be suitable for our purposes here. We are broadcasting here out of Texas, so we will pick city out here in the Metroplex. Okay, depreciable tax basis. Now, I mentioned this earlier. This is the purchase price less land. And so if you were to hover over this, you can see that there's some options here. We kind of talked about that during the second polling question of different ways you can determine the land value if you don't already know it. So if this was a current year study, in the sense that you acquired this property and you have yet to file the tax return, these are some resources you can use to determine what the final land value will be. So for this, let's just pick 500,000 for the basis, and you just type that in directly. And we will choose we'll assume this is a 2021 event, and we'll say this was acquired July 21st, 2021. Now I mentioned here about the 27.5-year life that's typical for residential rental property. Now, let's say you have what would be considered a residential rental property, only the client is not using it as a residential rental property. Again, they have to meet the standard to get the 27.5-year treatment. So if it's being used as an Airbnb or a short-term rental, then it would be 39-year property. And so if that's the case here, you would just click this button here and say yes, and so it would change your 27.5-year life to 39-year. And if you click over here, you can see this is just the definition of residential rental property. It's 50% of the rental units have to be used on more than a transient basis. It's so it's like 30 days. So long-term rentals meet the 27.5-year standard. But for this one, we'll assume this is a long-term rental, and we'll continue to use 27.5-year. Adjust my screen here a little bit. I have a scroll bar. One second, bear with me. Okay. So, what type of property? Go to the drop-down menu here, and remember I said we have up to 6 units, or a condo, or a townhouse. So, single family all the way up to 6. Let's assume that this is a single family home that's 2 stories. Now, building square footage, this excludes the basements, the garages, attics, etc. Just the building square footage, the livable square footage, excuse me. Let's assume this is a 2,500 square foot building. And then the lot square footage. Most lots are presented in acres, and so if you don't know the conversion between acres and square footage, you can hover over the mouse and see that 1 acre is 43,560 square feet. Now for the lot square footage, this is the entire lot, not the lot without the building on it. And so that's a very important thing to consider here, is we need to use the total lot square footage. So let's assume here that this is 10,000 square foot lot. Now, exterior wall type. We've got a couple different types here. Most commonly that you see, stucco, masonry, wood panel, or brick, or some sort of stone veneer. And if it doesn't fall under one of those 4, you can select the other. But let's assume for this exercise that we have a brick veneer building. And we'll say we have no basement. If you go to the drop-down menu, you can see we have no, finished, and unfinished. Then we want to consider the quality of the construction and the condition of the construction. Now, the quality of the construction, this is the quality from the original build. And so if you hover over here, you can see that this is the quality of the materials when they were originally installed. This is not considered the current condition they are in. We're going to consider that in the next one. And so if you drop down here, we've got average, economy, and high end. So let's just assume this was average construction quality. That's most construction is average, and so let's continue on with that. And then the physical condition. Now this is now considering what the state of the property is when you acquire it. And so in this case, we're considering aging. We want to look at the finishes, and we want to give ourselves a physical condition description. We've got average, needs updating, or excellent. So in this case, we'll pick average. What we'll do is we'll save and continue. Now, if you save and continue, and let's say you mess something up, it's okay. We've got a review tab here at the end, and you can easily go in and make any changes. You can also hit back. Once you continue on, you're not stuck with the information that's put in there. You could even save this. Let's say you only have a little bit of information right now and you get called into a meeting or something. You can save this, go back out to your dashboard, and you can pick it up later and it'll bring it back to right where you left off. So very handy there. So let's save and continue. Now let's go into the interior components here. So number of bedrooms. Let's assume this is a 4-bedroom, 3-bath house. Does it have fire sprinklers? If it does, you want to select yes. If it does not, then you don't want to select that. Flooring type. The flooring type is the same for every single room, but the choices are the same, I should say, but you want to choose the selection that is most like what you have in that particular room. So for this exercise, let's assume that the wet areas are laminate. So we'll pick laminate for kitchen and for bathrooms. Let's assume that the living room is laminate as well. And let's assume that the dining room is laminate. Now for the others, let's assume that we have carpet. So a carpeted master bedroom, carpeted other bedrooms. Maybe we have a den or some other family room. We'll say that it has carpet as well. And we'll say that the hallways have laminate. So when you're trying to sleep at night, you can hear everybody walking through the halls and making a lot of noise. So let's go to the other interior features here. We've got HVAC and its type. So depending on what part of the country you live in, you might have heating only, cooling only, heating and cooling, or you might not have any at all. So in that case, pick the one that's closest to what we have here. We'll assume that this is a both heated and cooled HVAC type. And then we've got a couple different types of HVAC. You have a central system with ducts, or you have an in-wall unit. And then you have both of those with radiant heating. So we'll assume here that we have a central system with ducting. Number of ceiling fans. This is pretty simple. You just count the number of ceiling fans in your home and you record that here. So we'll assume that we have 6 ceiling fans. And then let's go into window treatments. Again, pick the window treatment that's closest to what you have in the property. So we'll assume here that we have horizontal blinds. Now appliances. If you have the appliance, if this is, let's say this is a rental property, if the appliances are included, you can select them here. We've got dishwasher, range and oven, refrigerator, garbage disposal. Washer and dryer are presented as a unit, as a combination, and microwave. So let's assume that we have a dishwasher, washer and dryer. We'll assume that we have a range and oven, refrigerator, and we'll assume we have a garbage disposal. We won't consider a microwave. We'll say we don't have a microwave for this particular project. And then once we think we have everything entered in, again, knowing that we have the review tab, so we could still make changes. So for right now, we'll just assume everything looks good, and we'll move to the next tab. Okay, so exterior. This is pretty simple here. It's just a few things we have to consider. What type of parking garage do we have? Is the parking garage attached to the house? Is it detached, or do we not have a parking garage? We'll assume here we have an attached parking garage. And this is the total number of garage parking spaces within the attached or the detached garage. So we'll assume we have a 2-car garage for the modern American family. Exterior driveway parking spaces. This is how many parking spaces you have in your driveway. So we'll assume here that we can park 4 cars in our exterior driveway. Now let's look here at the site improvements. We've got pool, patio, deck, and landscaping. Now we have a question mark next to deck. So let's go ahead and hover over here and see what the program is telling us. So it's saying that if you have a swimming pool, that the decking associated with that swimming pool is already accounted for with the pool. So when you're selecting deck, you really should only be looking for a deck other than your swimming pool decking. So for our example, let's assume that we have all 4. We have a pool, we have a patio, we have a deck, and we have landscaping. Okay, last part here. We have fences and walls. Now, these are presented, there's 4 of them. They're presented in linear feet. So we need to measure the linear footage of the different fences and walls that are applicable here. If it's not applicable, then we skip this section. And if we look over here to the right-hand side, we've got some helpful notes that we've written. And for the walls and the fences, the note here says that Google Earth has tools and features that can be used to measure the perimeter of your lot, or it can be used for other site measurements. Now, in this situation, you would download Google Earth, you would make your selections, you would measure, and then you would put that information in here. And we've also helpfully put in a gate measurement. We say they're typically 5 feet wide, but you should measure your walls and fences and put in the accurate value. All right, so let's assume that we have 100 linear feet of chain link fencing, and let's say we have a nice fence in the front, blocking off the backyard and the front yard, and let's say we have 50 linear feet total of different fencing. Okay, so once we've got all that information in there, we will save and continue. And the last part here, this is the tax benefits. So what is our combined federal and state tax rate? What is our return on investment factor? Let's assume here that we are using a 43% combined federal and state tax. We'll assume 8% for return on investment. Now, if you remember, I put the place in service date as 2021. Now, if you're doing this study for 2021, you would select that tax year. If you're doing this study for, let's say this year, maybe we already placed it in service and we're going to be doing it for the 2022 tax year, so we're not making any change. Maybe we have to do a Form 3115 to take advantage of this in next year when we want to use it. But for this exercise, let's assume that we want to take advantage of cost segregation in the year in which we acquire the property. ADS, we talked a little bit about ADS earlier. Let's assume that we have no for ADS. And so if you click here, basically talks about what we talked about earlier on in the presentation. Businesses with less than $25 million in revenue, this is average over 3 years, are not required to use the alternative depreciation system, ADS. So because of that, we will get the 27.5-year treatment for the real property. And because we acquired this property in 2021, let's say that bonus depreciation is applicable. And since it's applicable, we need to select the rate for bonus depreciation. Still 2022, that's when the 100% bonus ends. And so this property was placed in service in 2021. So our bonus depreciation rate is 100%. And now we get to the last part, which is save and review. And so here's all of our information. And we want to go back in and we want to make any changes that need to be made before we select the final calculation. And so it's helpfully presented. You don't have to go tab through tab like we did before. It's all here at the end. And you can see here, we've got all of our inputs, everything carried over. Let's say we didn't have any changes we needed to make and we just wanted to run it the way it is. So we got this green button here, calculate. Got the disclaimer here, calculations are final. We encourage everyone to read the disclaimer before they agree to run the calculation. We'll agree here and we will proceed with the calculations. And we'll let this run. I'll take a drink of my coffee real quick. Okay, so here is the output from the RCS software. Cost segregation final results. We've got all of our information here. We have our additional tax deductions in year one, $147,000. We identified 9% of the basis in 5-year property and about 20% in the 15-year land improvements. So you can see this visually, and then we've also got a chart down here. And then you can also see how the depreciation looks over the life of the property. Now, since we have 100% bonus, all of the short life property gets written off in the first year. And so the depreciation deduction is very, very high in the first year. And then since you've depreciated fully the 5 and the 15-year property, what's remaining is the remaining basis left in 27.5 year that gets depreciated over a straight line for the remaining life of the property. And so you can see the depreciation visually in that perspective there. Had we not applied bonus here, you would see more of a skewed chart where the first 5 years would be where you would see the majority of the benefit because you're getting the reclass from the 5-year property and the 15-year property. And then after the 5-year mark, you'd be looking at the next 10 years of 15-year property that's remaining on the land improvements. And then finally, after the 15 years, then you would start to see this where you just have a 27.5% or 27.5 year recovery period for residential rental property. One thing I do want to point out here is that we have a project reference code. So let's say you were taking advantage of cost segregation for a prior year study. This code here can be exported to our 481A adjustment software. And so all you would have to do is input that information from your depreciation schedule. It'll populate the results, and you can run the 41A calc and report that on IRS Form 3115. So pretty handy stuff there. And every project that you do for the RCS generates a reference code that can be used in the 41A software. And so we have a couple different things here. We can export this to PDF, or we can export it to Excel, depending on what we want to look at. And here's basically what gets exported to Excel. It's this second page here, this chart. And so you remembered earlier, we were talking about partial dispositions, the second part of a cost segregation study. First part we did on page 1. We identified the 5-year and we identified the 15-year. The second part, this is the allocated purchase price, or purchase cost is the allocated depreciation or depreciable basis to the different components within the building. And so if you have to go in and make any future dispositions, you know, if you replace the windows like we talked about, roof covering, that's a pretty typical event that you do when you own real estate. Usually comes up and you have that basis right there. You can write off the value of the remaining, you're applying the depreciation to it, but you're writing off the remaining value of that asset. You've got it right here. And then we just have everything on the third page. This is just all the property details that we just went over. Okay, so let's jump back into the webinar here. And here's just some typical examples of what we would have for residential cost segregator. And so you can see here is a duplex, single family rental, 3 units, different purchase prices, different years. You know, this is what we kind of talked about where it didn't have bonus. And so you'll see that the different years 1 through 5 values, you know, depending on how much is allocated to shoreline property. All right, so some screenshots here. This is basically what we went over here. Excuse me, using the RCS software. You can see the different things here. So about the 47-minute mark, we've got one more polling question I got to get to. So we'll get through the next few slides here, and let's talk a little bit more about retirements and partial dispositions. So current regulations, they allow you to take the loss deduction when you remove the component from your building. Now, this has to be done this year, or the year in which you make the removal, that's the year you have to claim the deduction. You can't go back in and claim deductions for components that were removed in prior years. It has to be done in the current year. So let's say, for example, we paid $50,000 and we replaced all the HVAC in our building. Because that's a capitalizable event, we will capitalize that amount over 39 years as real property. Now, what we can do is we can figure out how much of the old HVAC was not written off, and we can claim all that as an immediate deduction. And we can do this going forward. So let's consider an example here. We've got a building that was acquired 3 years ago for $5 million. Now, let's say this year we went in and we spent $1 million and we remodeled it. We went in and changed the entire second floor. We determined the original cost of the demolished components is $470,000. This is from the original $5 million building. Because of that, we can look at this for the partial disposition, and we can recognize a loss of $430,000 on the current tax return. And so that's the original cost of the demolished components with depreciation taken into account. Depreciation that's already been taken on those assets. And so we talked a little bit about this when we were going through the dashboard for the RCS, but we do have a partial disposition calculator. And there's really a couple ways you can do this. You can look at the cost segregation study. You saw that when we had the breakdown from the different components from doing the RCS exercise. But let's say you don't have the cost segregation study and you need some other way to rely on that. Well, you can use this partial disposition calculator. And what it does is it uses the producer price index, PPI, and it basically goes in and figures out how much of your replacement component can be written off, and it goes in and you put in some information. And we don't have time to go into the demonstration of it, but let's talk about this with an example. So in addition to discounting the new costs, we should also consider the condition of the component. So the new cost plus the condition of the component when it was acquired. So let's say in our example, we acquired this building 3 years ago. We spent $200,000 to replace the aluminum windows. We did this year. Using the partial disposition calculator, we figure out that we have $186,000 for removed windows. Now, this is just the value of a replacement cost, so the brand new windows. But the windows that we removed in the building, they only had 3 years of life left. So we need to apply a condition factor to make sure we account for the fact that these weren't brand new windows that we got rid of. These were windows that only had a few years of usable life left. So in this example here, we've got the normal life of windows, which is 20 years. And we apply the condition factor. And in this example, the condition factor is 27%. And we figure out how much of that value from the original 186 is with the condition factor applied. It's approximately $50,000. And so what you would do is you would report that $50,000 on your tax return. And so we'll go a little bit more into this here. I'll show you some screenshots from the solution software, but essentially you enter in some information here, just like the example that we did, and it comes out with the adjusted component with the condition, and this is the value that you would report on your tax return to claim the partial disposition. All right, so if you're considering cost segregation, you really want to make sure you evaluate your cost segregation service provider. Got a few things up here that you may want to consider when you're evaluating a firm. You maybe want to look for a certified cost segregation professional designation from the American Society of Cost Segregation Professionals, checking bios, resumes, evaluating just the references of clients. There's a lot of information, and just want to make sure you choose a firm that you can trust and choose a firm that'll help you maximize the benefits on owning your real estate. And got a few other slides here. I'll just kind of go through these briefly, and then I'll put my contact information up. But there's other services out there, not just cost segregation. There's other things you might consider. There's Section 45L residential energy tax credits. There's 179D commercial energy deductions, research and development, transfer pricing, IC disc, fixed asset tax reviews. A lot of other stuff out there, not just cost segregation. We do have some other webinars, if you're interested, that kind of take a deeper dive into some of these other concepts. So we basically went through the ins and outs of cost segregation, and we went through some of the different tools and tax planning strategies, and then the RCS software. So I hope everyone got a lot of information out of that. I'm going to put my contact slide up here. If anybody has any questions that didn't get addressed in the chat, or if you just have something you want to send my way, I'm happy to answer questions and try to help you out. Here's my information here. So I want to thank everyone for joining us today. I'm going to send it back over to Chris, who's going to give you a little bit more information on some of the material that we covered here. Thanks, everyone. Have a great rest of your week.
For those that want to know more about the pricing tools used in this presentation, the partial disposition calculator is available for $90 for 24 hours or $550 annually to use it as often as you like. The residential cost segregation tool includes a free audit support and only $450 per report. We also have discounts available if you want to do multiple reports at one time. Feel free to reach out to us if you have any questions about pricing. If you prefer engaging with people and being social versus crunching numbers all day, our business development team is looking for CPAs and tax staff seeking a career that utilizes your social skills with a flexible work schedule from any location. To find out more, please visit kbkg.com/careers. This concludes our presentation today. Thank you for joining, and have a great rest of the day.